Welcome back, everyone. Now going to announce the second half of the Green Budget. We're going to kick off with ICAEW's presentation on the whole of government accounts and options for funding infrastructure. So I will hand over to Ross, who will take you through that. Thank you.
Hello, everybody. I'd just like to say good afternoon, but I'd also like to say Happy New Year, because when I think of the times we've been living in, the sort of Chinese expression, living in interesting times, seems very much to be pertinent. I'm going to talk a little bit about an accountancy perspective on the public finances. I'm going to talk a bit about the whole of government accounts, which I think provides an insight you don't get from the national accounts. It's certainly in terms of the financial position of government, but still isn't quite the management tool it should be because it takes so long to produce. And then I'm going to talk a little bit about the challenges of funding infrastructure, particularly in the light of the fiscal mandate rule and some of the potential policy choices that might be available to the Chancellor, and maybe a final reflection on why we might want to modify the fiscal charter rule. So we've now got 5 years of the whole of government accounts. These are integrated financial accounts, very much like most companies produce. They're produced to the same accounting standards, international financial reporting standards that companies use, which are relatively universally adopted and are generally accepted accounting practice. Government makes relatively little modification to them, and they're audited. So we can pretty much rely on these numbers. There's a revenue and expenditure account, these days called the Statement of Comprehensive Revenue and Expenditure, used to be the profit and loss account, and there's a balance sheet, which shows the assets and liabilities of government. There's also a cash flow statement, which essentially forms a bridge between the two. I think what's interesting about the cash flow statement is it shows the extent to which government is generating or consuming cash. And one of the insights is roughly when government's raising cash, it's spending about half of it on investment. The rest is going on the running costs, which is never a great state of affairs when you're essentially borrowing on the credit card to pay the household bills. Not a good outcome. There's also a statement of comprehensive income, which takes account some of what we call the balance sheet movements, the write-downs or the write-ups in assets and liabilities broadly, and that gives an overall movement in financial position. So it's capturing more than the national accounts do from an entity perspective, and what it's really trying to do is say, much in the way that company directors need to show stewardship of the assets they hold on behalf of state shareholders, that they're looking after the investment. These accounts provide a similar sort of stewardship statement to the taxpayers and their elected representatives in Parliament. So what does it show us? Well, this is the most recent whole of government accounts with a balance sheet at 31st March 2014. That's almost 2 years ago, and these still are the most recently published numbers. Currently, Treasury has managed to get publication a bit earlier. It's being done in 12 months as opposed to 2 years, where it was a start point 5 years ago. But these are the most up-to-date numbers, and that is something we really think government needs to work harder at. What it shows is we're still spending more than we earn in accounting terms as well as national accounts terms. And we've got a larger accounting deficit in that year than the national accounts deficit was, considerably larger, in fact. And the balance sheet, again, when you take into account the liabilities of government, and all these liabilities are essentially commitments to pay money. This is not a budget or a forecast. There has to be a hard commitment to spend the money for it to be recognised in the accounts. It shows that we're roughly 1.8 trillion in net liability. And all of this money has to be paid out at some point, possibly in the future. The way the accounting standards work is that is the best estimate of this future costs to settle the liabilities expressed in today's values. Looking over 5 years on the P&L side, the profit and loss or revenue and expenditure side, we can see that the situation has been improving, but we are still running a deficit, and that deficit has not been coming down as fast in accounting terms as the national accounts deficit. Now, there are a number of reasons for that. We are having to write down assets in the books of the government. We have costs, the cost of making provisions, for example, for future liabilities that we don't have in the national accounts measures of the deficit. But broadly, you can see we still have some way to go. Looking at the balance sheet, we can see that actually the asset position of government, despite asset sales, has remained reasonably stable. There are a number of reasons for that. Government current values its assets, which means it uplifts the value every year, though I think it's interesting that they also write down the asset values every year. So there's something interesting going on there, and that's maybe one we'll deal with in next year's Green Budget. But we can really see that what is growing, and for the last few years, 300 billion per annum, the overall liabilities. Now, some of that is the national debt. Some of that are pension liabilities. It's almost 50-50. But pension liabilities are being driven by, one, the fact we're in a low interest rate environment and we can't make the assumptions about growth, and that flows through to a low discount factor. But also there's a powerful demographic component here. We have an aging population. I think the point I'll make here as well is the pension liabilities we're talking about here are only for the state employees. We don't include, or the government doesn't include, it doesn't recognise the general state pension in these figures. That's because it's a policy choice. There isn't actually a contractual commitment to pay it out. So it doesn't meet the recognition rules for the accounting standards. But were we to add that, I think we'd be looking at close to another 5.5 trillion of liability, all of which changing, well, assuming no major change in government policy, has to be paid out of future tax revenues. I think also, what do we conclude from this? We conclude from this that actually the government doesn't have an awful lot of room for manoeuvre. It's got a lot of commitments, a lot of claims on the tax revenues it's going to raise over the forthcoming periods, and were it to face another economic shock, its capacity to make good choices about what to do or what not to do is constrained by the fact it has a very large liability picture to settle, and presumably, limited flexibility on the asset side. Now, we know the MOD is probably sitting on too much land. It still owns about 1% of the UK land mass, which these accounts show us as well. But equally, if it were straightforward to dispose of, we would have probably seen it disposed of in the last Parliament. So, and credit to the Treasury, they have made a lot of improvements in producing these numbers. They've really pushed down the preparation time. They've halved it, essentially, over the period that these reports have been published. But it's still not close to the sort of times that large corporates report in. One other factor that actually has made a lot of improvement is this is now driving standardization of accounting policies across all of the public sector. And my goodness me, they weren't standard previously. So things were not being accounted for on the same basis. We're now getting apples and apples rather than apples, and I wouldn't even say another fruit. It's probably vegetables in some cases. But we're starting to see a good set of coherent figures, if not timely ones, and they are starting to be used to support policy choices and decision-making around the liability side, around, for example, how we modify pensions. What we haven't seen yet, though, are the changes to the pensions that were made over a year ago flow through into the numbers yet, because we don't have the numbers yet. Obviously, there's more to do. Treasury set out a target of 9 months to try and achieve publication for this year's accounts. That's not going to be met. There are problems at the Department for Education, principally. But part of the reason that it does take so long to produce these accounts, whereas individual government departments mostly produce their financial accounts in about 3 months, the systems are not joined up, and as a consequence, you have a sort of incoherent arrangement where you can't just lift the numbers and run this off an accounting system. There's a huge manual intensive exercise which does slow the whole process down. And also sort of byproduct of that is we don't have the sort of reporting you'd see in a business where there is good monthly, high quality reporting that is comprehensive and takes into account movements in assets and liabilities as well as simply revenue and expenses. And I think until you have that, it's actually quite hard to get a real grip on financial management. So those are real areas where we think the Treasury in particular, but government more generally, needs to focus efforts to improve. So, we really do think, and we touch on this in our Modern Finance Ministry publication, that it's time to embed proper financial management in Whitehall. There's too much at stake here. These are very big numbers, and this is money that we are going to have to settle as a nation at some point. It would be nice to see it more actively engaged with, and I think, well, it's in our interest to see it more actively engaged with, but we need to see a little bit of investment to actually properly do financial management. I'm going to turn to infrastructure funding now. I think infrastructure is, of interest to us, largely because it is a driver of economic growth, national competitive advantage, and it's critical to the performance of the economy in the long run. But at the same time, as Carl was very articulate in explaining, we have a fiscal charter rule that makes it very difficult to borrow to fund additional investment. So, what are the policy choices available to the Chancellor to make those investments in infrastructure that will contribute to growth, will drive the revenue side of the equation, which, let's face it, is as important in delivering a surplus as managing the expenses? If there's no new borrowing, what can you do? Well, you could find additional savings by cutting operational spending, perhaps, but in reality, I think most of the easy stuff has been done, and as long as hard protections exist to things like pensions, the triple lock, that exist to healthcare, welfare, education, defence, the scope of the areas of public spending that is left to make those reductions for is limited. You can do more PFI as an alternative. PFI still doesn't score as capital expenditure, and the associated debt doesn't score as capital expenditure, in most cases, in the national accounts. But is that necessarily the filter that you want to apply to building infrastructure, that it slips through on some accounting rule? Hard to say. Of course, you can try and encourage investment in infrastructure by the private sector, and you can try and create incentives. You can either offer support to their ability to borrow, things like the credit guarantee scheme, or set market incentives, like the regulated utilities have. Or maybe another way to look at it is think about making investments that pay for themselves over their life cycle, which seems to me what you do in business if you were judging how to do this. And public expenditure or projections of investment in infrastructure over the next 4 years is pretty much flat. It's not till about 1920 that we actually see an uptake in investment, and even then it's not significant. So, does that meet the infrastructure challenge? I would suggest it is probably not enough, not if this is going to be the real engine of growth. PFI, I mean, the accounting get out of jail free card for infrastructure investment. I think the truth is, after 2008, PFI investment fell off a cliff as a consequence of the liquidity problems in the funding market. When times are tight and banks are rebuilding their balance sheets, what they don't want to do is lend extremely long-term at low rates of return. It compounds the problem from their perspective. And PFI really has fallen to a fraction of the business it was, largely because of loss of debt market capacity. Though some might say many of the obvious things to PFI had already been PFI'd as well. In fact, PFI contracts are only just under 3% of net debt now. And it does make us wonder, given they are broadly neutral to the deficit as well, as long as you're not particularly growing the PFI program, isn't it time to maybe just bring them onto the books and treat them like other infrastructure investment? Because this is essentially the debt of government, and I think in the long run, even Eurostat and ESA is probably going to change to reflect that. So, now would be the time to take the hit, just bring it onto the books. It's a good opportunity. Other infrastructure investment, well, the National Infrastructure Commission has identified about 47 billion a year, much of which comes from the private sector. We can see very heavy private sector investment in the energy sector, and most government infrastructure investment planned to go into transport. In fact, I believe that's largely maintenance of the road network that we're seeing there. So the story so far, I mean, the infrastructure funding market has not recovered to pre-2008 levels. There's been a loss of roughly half the market capacity in that infrastructure bond issuance has pretty much disappeared. We've lost the monoline insurers who underpinned it, and it costs more. So again, do you really want to use private finance? Question. Government's tried. It's brought out a new range of PFI contracts called PF2. It co-invests under those projects to try and stimulate investment. It's provided regulatory and market incentives, and actually that's worked in the utilities sector quite well, and up until recently in the renewables energy sector, but it does depend on stability and confidence and low levels of political risk. And the UK guarantee scheme has raised about 1.7 billion, but out of a 20 billion pot that was available. So I think, partial success at best. Other attempts to widen the pool of finance, to bring pensions investors in, again, I think moderate success. It's raised about £1 billion, but actually out of the potential money out there, it's not delivered anything like as much infrastructure funding as we would have hoped to have seen. So consequently, we think it's time for a different approach. We think that rather than the current approach, where there is a capital budget set and we have PFI that is struggling a little, but gets this sort of golden pass that allows it to be off balance sheet, so it doesn't get trapped by the fiscal charter rule. We actually think if you bring PFI on balance sheet, treat it like any other form of public infrastructure spending, put it on a level playing field, but modify the fiscal charter rule just a little bit to say, actually, where you do identify projects that pay for themselves because they generate economic growth, and we know there are methodologies around to establish whether or not that would be the case. allow them to be funded, borrow to fund those projects, because they'll pay for themselves and they'll make a net contribution to the economy over time. We think that would be a pragmatic and sensible thing to do. It's what a business would do. We don't really see any good reason why the government can't do it either. That's all I have on these subjects, and I shall now hand over to Thomas.